A common strategy in retail investing involves searching for stocks trading significantly below their historical price-to-earnings median, treating the discount as an automatic buy signal. Take this case study. A company whose current PE ratio sits 48% below its 5-year historical average. On the surface, the discount looks like an obvious opportunity, yet the valuation algorithm flags this exact stock as fairly valued. The massive historical discount is being countered by other data points in the model. Judging a business solely on its equity is like weighing a golden idol without accounting for the weight of a hidden iron anvil. Accurate valuation requires proving the current price is justified based on the company's specific capital structure. Reconciling the gap between a low PE and a fair verdict involves applying specific valuation lenses, moving from historical baselines to the logic the market is using to price the stock today. This discrepancy between the historical average and the current verdict indicates that a single low multiple can often mask underlying factors the market has already identified. The foundational calculation for the fair value baseline uses the current earnings per share multiplied by the 5-year median PE. The model then maps out probability zones. A stock earns a very attractive flag only when it trades at a discount of 30% or more relative to that fair value. However, the PE ratio is often the wrong tool for asset-heavy sectors like energy or infrastructure. For these companies, the algorithm applies a primary tag to a different metric. By adding corporate debt to equity, we get enterprise value, the complete capital structure. For debt-heavy sectors, focus shifts to EV to EBITDA. While PE looked cheap, the debt-adjusted EV to EBITDA sits exactly at its historical median. Banking and finance stocks require another shift. For those institutions, PE and EV to EBITDA are set aside in favor of the price-to-book ratio. The algorithmic hierarchy ensures that if the sector primary metric is neutral, it carries more weight than a secondary metric that appears discounted. The fairly valued label reflects this logic, identifying when a stock's perceived cheapness is offset by its debt obligations. Historical comparisons are really only the first step. If the entire market has shifted, a stock that looks cheap compared to its own past may still be expensive in the current climate. The Nifty 50 benchmark check accounts for this, showing if a stock's multiples are actually a bargain relative to the broader index levels. Next, we must determine if the company's internal growth supports the multiple. A low PE is only a value if the profit velocity justifies the entry price. The PEG ratio calculates this by dividing the current PE of 23.6 by the 15% profit growth rate, resulting in 1.54. When the needle hits the yellow getting expensive zone, the PE multiple outpaces the company's actual growth. There are limitations to this ratio. In cyclical businesses recovering from a low base year, the high profit CAGR can produce a deceptively low PEG. Multiples are most useful when they are stress-tested against both the macroeconomic environment and the sustainability of the company's growth. Standard valuation models often rely on predicting future growth rates, an exercise that involves significant guesswork. The Reverse DCF framework changes the perspective. Instead of forecasting the future, we analyze what the market is currently pricing in. This diagram shows the logic working backwards. By starting with the current stock price, we can calculate the exact growth rate the market expects the company to deliver. This calculation requires 3 fixed inputs: the current price, a 12% discount rate, and a consistent exit multiple. In our case study, the market price demands an annual growth rate of only 6.1%. We compare that 6.1% expectation against the company's actual 5-year historical growth of 15.3%. Finding a market expectation that sits well below a company's historical performance identifies a measurable margin of safety. Moving from historical data to forward-looking projections allows for testing assumptions over a 3-year horizon. This is the scenario valuation interface. As shown in the top left, the base case is automatically seeded with the 5-year historical median PE of 45.0. The model includes an earnings mode for bottom-line growth and an alternative mode for analyzing operating margins. Selecting the OPM toggle at the top changes the logic. This is used when a specific thesis depends on whether margins will expand or compress over time. Scenario valuation is used primarily to define the downside risk by adjusting the bear case inputs. Lowering the bear growth assumptions and discounting the exit multiple allows an analyst to simulate the impact of a worst-case economic scenario. Analysis reaches its conclusion when even the stress-tested bear scenario results in a positive projected return. The initial 48% PE discount was a misleading signal because it failed to account for the debt-heavy capital structure revealed by the enterprise multiples. In-depth research relies on building a sequence of overlapping verifications rather than chasing a single multiple. This involves correcting for debt, normalizing against market benchmarks, and using reverse logic to measure current pessimism. Each analytical step acts just like a solid support in a bridge, ultimately leading to the secure placement of the final keystone. Rigorous analysis focuses on the systematic removal of blind spots to determine the exact level of risk inherent in the current price.